Yeah, so I get a real problem with mortgage insurance because I've seen over and over again how it doesn't pay. So mortgage insurance is called underwritten at time of claim. So underwritten at time of claim, what does that mean? It means they actually look at your medical questions at time of death or time of disability or critical illness. So what happens is you go to the bank, you fill out those pages of questions you declined today, Christina, and you go, yep, 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 and they go, okay, great, you've got mortgage insurance. They're going to take that file, they're going to put it in their filing cabinet, and they're going to sit there, and then down the road, if something happens, let's say 5 years, that person passes away, the bank is going to say, okay, well, let's decide if we need to pay this claim. And they're going to go take the file, they're going to go through it, they're going to go to your doctor, ask your doctor some questions, and they're going to try to find a reason why not to pay the claim, or not necessarily try to find a reason, but often they find a reason not to pay the claim. So that's underwritten at time of claim. With an insurance company, with term insurance, with a licensed advisor, you're going to get term insurance underwritten at time of issue. In other words, when they issue the contract, you're going to be approved at time of issue. So in other words, they're going to ask some medical questions and they're going to say yes, no, or rating. And if they say yes, you're approved, when you die in 5 years, they're not going to go back and dig through the file and try to go through to see if they're going to pay the claim. You were already approved. And again, the people that think they're covered for mortgage insurance, that wouldn't actually get paid is a much higher than people talk. And we see all kinds of stories in the paper about, my spouse died and the bank wouldn't pay. For me, I've got my personal story is my mom and dad, when they're in their 50s, built a year-round cottage down by our family cottage. And mom called me up all excited and she goes, "Oh, your father, the bank gave your father disability insurance on the mortgage." And I'm like, "No, they didn't." And she's like, "Yeah, yeah, no, I've got it right here." And I go, "Okay." So she sent it over to me. I got a little letter signed from her saying the bank could talk to me directly. So I talked to this bank teller or associate or whatever they were, and I go, "Okay, question number like 6 of 50." They list about 20 conditions, and one of them was neurological disease. And I go, "My father has Parkinson's," and she goes, "Yeah, yeah, I know. We talked about that, but I didn't think that was a neurological disease." So what would have happened in that situation is they would have paid the premium, and then at time of claim, 5, 10 years down the road, the bank would have said, "Oh no, you don't qualify for that coverage because you have Parkinson's." So that is just that false sense of coverage with sometimes with that mortgage insurance versus the term insurance. You're going to know up front, are you approved, are you declined, and you know that up front. To me, that's probably one of the most important differences, and it's just that peace of mind knowing, yes, I'm covered. Ooh, I hope I'm covered if something happens. So that to me is a huge one.